I've been trading for over 5+ years and I've taken thousands of trades and I've made over 7 figures in my trading career. And in today's video, I'm going to share with you 7 of the most important lessons that I've learned throughout my 5+ years of trading that nobody talks about. So with that being said, let's not waste any time and let's get straight into the video. So in today's video, I'm going to talk about the most important part of trading that nobody talks about. And this has allowed me to make consistently over $50,000 a month this year. This is my last 30 days P&L. And as you can see, I'm up over $80,000 in the past 30 days. And I just want to mention that this took over 5+ years of experience trading, failing, refining my system, and finding my edge in the markets. So in today's video, I want to talk about the 7 key lessons that I've learned throughout my 5+ years of trading. Let's go on to lesson number one. Number one is overcomplicating your trading strategy. When you're a beginner trader, there's so many different strategies and systems out there. You feel like the more strategies you understand, the more indicators you have on the chart, it's going to make you a more profitable trader. But that is not the case because simplicity equals profitability. Simplicity beats complexity. And what you have to understand is that you need to stop strategy hopping. So many people trade ICT, SMC, supply and demand, support and resistance. There's so many different trading strategies out there. And what you have to understand is that every single trading strategy works. And there's no one strategy that is better than another. What you have to do is find a strategy that you align with and that fits your personality and stick to it. And a lot of people ask, then what strategy should I choose if there's so many different strategies? So what you want to do is pick to one strategy and stick to it long enough to prove or disprove an edge before adding anything else. So let's say, for example, you trade classic support and resistance. This is a strategy that a lot of traders use. I know a bunch of profitable traders that trade support and resistance just straight off of key levels. If you trade support and resistance and you found an edge while trading support and resistance, there's no reason to look for any other trading strategy until you figure out if support and resistance is going to work for you. If it works for you, great. You can look to add other confluences or other setups that are within support and resistance. Let's say you don't find any success with support and resistance, then you can go on to trading something like supply and demand or price action or order flow or ICT or SMC. But you only do this after you've proven to yourself long enough that support and resistance doesn't work for you. So understanding that every strategy works, you just have to find out what works for you. And this brings me to my second point, which is trade price action, not noise. I know a lot of you guys' charts when you first started trading looks like this, or maybe your chart still looks like this, where you have so many indicators, you have the EMAs, you have the clouds, you have RSI, MACD, Bollinger Bands. Whenever your chart looks like this, it's way too cluttered. What you have to understand is that indicators are a derivative of price. So why not focus on price in itself? Indicators are lagging price. So when you focus on what really matters, which is price action and understanding liquidity, indicators are great when you have other confluences that align with your system, but don't expect indicators themselves to make you profitable. So as I mentioned, if you want to trade indicators, have a few indicators and have them working in confluence with your trading strategy. And as you can see here, compared to the chart above, all we're focusing on is just key levels, right? Old highs and old lows on the chart. And these levels would be used as, right, resistance, right, turn into support levels. And you can see how nice reactions that price will have off these key levels, just because this is what really matters on the chart, right? These old highs and old lows where there's a liquidity resting above and below those levels. And if you plot these levels on the chart, these are going to present the best opportunities possible. There's so many different trading strategies and systems out there, and you might be asking, what do I trade personally? My trading system all revolves around the break and retest. So the break and retest is my strategy slash system, and I have a bunch of setups within the strategy and system in itself. So simply the break and retest is looking for your old resistance to turn into support. So in the simplest terms, as you can see here, I made it nice and easy. We have a swing high, which is used as resistance. We break above that swing high, so we have a breaker structure. Now what we're going to be doing is looking to use this previous resistance level that turns into support for continuation. Of course, this isn't always how it's played out in real time, but I'm just marking this out as a line illustration. I have plenty of videos on my full strategy and system that you can take a look at. And within the break and retest, I have 3 primary setups that I look for on a day-to-day basis. Number one, what I have is the opening range retest. The opening range retest is one of my favorites. All you're doing is marking out the first candle high along with the first candle low. And so in this case, what I have drawn out here is the 5-minute range. So right at 9:30 a.m. Eastern Standard Time, you want to mark out the high and low of the first 5-minute candle. So what we're going to do in this case is mark out that first 5-minute candle high. As you can see, it's 1, 2, 3, 4, 5. We're on the 1 minute time frame. We're going to mark out the high. We're going to mark out the low. And what we're going to be doing is waiting for a break above, retest, and continuation. If it was towards the downside, we'd be looking for the retest underneath for continuation towards the downside. This is one of my favorite setups. It's called the opening range break and retest. I have plenty of other videos on my channel explaining the opening range retest. So if you want more information, you can check that out. Second, what we have is your previous day high / previous day low retest. What we're going to do is mark out our previous day highs and our previous day lows. So this is the levels that have the most liquidity, right, above your old highs and old lows on the daily chart. So what we're going to be doing is similar thing to the opening range retest, but in this case, we're using a higher time frame candle. So this one's going to be a lot more higher probability. So what we're going to be doing is a similar thing, looking for the break above for continuation towards the upside, or if you want to see continuation underneath your previous day lows, we're going to be looking for the retest underneath your previous day lows for continuation lower. And the final one in this case is our order block break and retest. So in this case, what we're going to do is mark out up close candles in a downtrend, or we're going to be marking out down close candles in an uptrend. So as you can see in this case, we have a clear downtrend in the markets. We're making lower lows, lower highs, lower lows, and we're pushing lower. What do we want to do? We want to mark out up close candles. So in this case, we can mark it out from the wick to the body to make it nice and easy. Price breaks underneath, come back up, retest. You can be looking for an entry, right? Stop, just a break above, and we can be looking for now continuation back towards the downside. So this is the order block break and retest. I have plenty of videos on all three of these setups. So if you do want more information on how I trade these, you can check out those videos. And with that being said, that is my system and strategy that I use. I try and keep it as simple as possible. Now let's go on to the next lesson that I have for us today. The next lesson that I have for us today is arguably one of the most important lessons, and that is being able to manage risk and have proper risk management. Risk management is one of the most overlooked aspects when you first start trading, because all you're doing is focused on making money, and you're not actually focused on how much you're risking and what it takes to make that money. As I mentioned, this is the single most important part about trading, and it doesn't matter how good of a trader you are if you don't have risk management. The reason being is because when you first start trading, you can have a string of winning trades. You can go weeks or months of winning, but all it takes is 1 to 2 bad trades where you over leverage and you can lose it all. So as a trader, understanding risk management and having proper risk management is so important. And one of the most common mistakes that I see for beginner traders is not having a stop loss. Having a stop loss is one of the most important aspects because you understand how much you're willing to risk on a given trade. When you first start trading, if you don't have a stop loss or a point of invalidation, and what's going to happen is you're going to be trading strictly based off of your P&L and not actually what matters, which is the actual chart in itself. And when we're talking about risk approach and how much we should risk per trade, a good rule of thumb is risking 1 to 2% per trade based off of your total account size. So for example, as you can see here, let's say we have a $25,000 account. We want to risk 1%. 1% is fairly standard, which equals to $250. So $250 is our R multiple. So the max we're risking per trade is going to be $250. So if we risk $250 per trade, and that means we're able to weather drawdown and have a period of losing streaks where we don't blow our accounts. So we can lose $250 5 to 10 times and it'd still be very reasonable. That would only be a 10 to 20% drawdown. Whereas if you're risking 10% of your account, if you take more than a few losing trades in a row, you're going to blow your full account. Same thing with $100,000. If you're risking 1%, that equates to $1,000, which is your 1R. So that's going to be the max you're risking per trade. So what matters in this case should be your percentage and not the actual dollar amount in itself. And a good rule of thumb, as I mentioned, is 1 to 2%. And that will keep you from over leveraging in the beginning and having proper risk. And this brings me to my second point, which is how much should you trade with? So this is a common question that I always get asked. A lot of beginner traders always question, should I trade with $5,000, $10,000, $100,000? How much should you trade with in the beginning? The amount that you should be trading with is money that you can afford to lose. Everyone is always in different financial circumstances. You want to be trading with money that you can afford to lose, especially in the beginning. If you can't afford to lose the money, you shouldn't be trading, right? Understand that trading is all about probabilities. There's a very good chance you're going to lose money in the beginning when you're in the learning phase. So think about money that you can afford to lose, and that will be your market tuition. So you want to be losing as small of an amount as possible, either that be $5, $10, or $50. As I mentioned, it depends on a per person basis. This means if you have bills to pay or rent due, you don't want to be trading with money that can be used to pay those bills, because you're going to be thinking the whole time while you're trading, right, I can use this money to pay bills if I lose this. So understanding that there are mental barriers. We'll touch up on this in a second, but it's money that you can afford to lose. Next is understanding R multiple. So in this case, we have two traders. You have trader A and trader B. B. For example, they both have $25,000 accounts. One trader is risking 1 hour per trade, has a 75% win rate. Another trader is risking 2 hour per trade and has a 50% win rate. Based off of these two traders, most people would think that trader A is going to be the more profitable trader because they have a higher win rate. So in this case, let's say both traders take 10 trades. Trader A wins 75% of the time, 7.5 wins, 2.5 losses. Trader B wins 50% of the time, so 5 wins and 5 losses. Based off of the information that we have, which trader do you think would make more money at the end of the day? So as you can see here, both trader A and trader B end up with the same ending balance of both $30,000 with a 75% win rate, profit of $7,500. The loss ends up being $2,500, so a $5,000 profit, and that equates to $30,000, as you can see here. For a 2 hour trader with 50% win rate, $10,000 profit, $5,000 loss. Similar scenario, we end up with $30,000. But in this case, both the traders end up with the exact same amount, but they both have different win rates. And why is this the case? And most people think that high win rate equals success, and that is not the case. As you can see here, what matters is risk to reward. And basically what risk to reward is asking ourselves how much we're looking to risk in order to gain. So in this case, it's a 1-to-1. So for example, let's say $100 is our risk. We're looking for $100, right? That's a 1-to-1. For a 1-to-2, let's say we have $100 again. We're looking for a minimum of $200. In a 1-to-3, we're looking to risk $100 in order to gain $300. So of course, when we're trading, we want a high risk to reward. What comes with the higher risk to reward is a lower win rate. And if you have a lower risk to reward, then you're going to need a higher win rate. So understanding the risk to reward is very key when it comes to trading. So what we have in this case is a risk to reward versus win rate cheat sheet. You can take a screenshot of this cheat sheet or find this online. But basically, as you can see in the red, what you have is a negative expectancy. If you're in the green, what you have is a positive expectancy. So that basically means green, profitable, red, you're not profitable, and yellow, you are break even. So what you want to do is align yourself with a strategy and system that makes it so you're in this green box. So I personally lie around anywhere between 40 to 60%, and I look for a 1-to-2. So I lie somewhere in this general area, which is going to be a 40 to 60% win rate and a 1-to-2 risk reward or a 1-to-3, and depending on the month and the certain market conditions. So study this chart and see where you lie based off of your trading strategy. And finally, what I want to talk about is maximum drawdown when it comes to trading. Maximum drawdown, and it's basically asking yourself the max amount of money you're willing to lose at any given time. And this can be a daily, weekly, or total account size drawdown. Preferably, you want to have all three. And this is calculated after everything else. So a good rule of thumb is that you should lose no more than 5 to 10% of your account on any given day. So for example, let's say you have a 25K account, the max you're willing to risk on any given day is 10%. So $25,000 times 10% equals $2,500. So your max drawdown on the day is $2,500. You can do this either mentally. The best case is usually to have a broker max drawdown where it kicks you out and doesn't let you trade, because a lot of times when you're close to your max drawdown, you're going to want to over trade, and sometimes that spirals into even more trading and you end up losing more than you'd like to. So being able to restrict yourself from even getting to that point is the best case scenario. So having a max drawdown is very important, and it's there to protect yourself so you don't blow your account and end up losing way more than you want to, or lose 50% of your account in one day, because I feel like we've all been there, and losing 50% of your account is not fun, especially when you first start trading. It's very demotivating and really takes a mental toll. So, and with that being said, now let's go on to the next lesson that I have. Number 3, what we have here is controlling and understanding emotions. When you first started trading, you hear things like you want to trade like a robot, you want to have no emotions, but of course that's not realistic, because at the end of the day, we're humans and we have emotions, right? That's part of ourselves. So what are we going to do to control emotions and understand emotions? Number 1 is having rules in place, and that will decrease our discretion and rely on a more mechanical trading approach. So having trading criteria, rules will allow us to understand exactly what we're looking for. So if we have entries, exits, stops, etc., right? These are trading criteria that we have, at least from a mechanical side and a trading approach. We have also other rules in place strictly for our emotional side and our psychological side. Also, another thing to mention when understanding our emotions is journaling emotions. Most people track their statistics. They only track numbers that are tangible, but what you also have to do is journal your emotions, right? Not just trades. You have to note fear, excitement, and the actions that they trigger, because there's going to be different scenarios that you might not understand and then you can't see that are surface level. And you have to do this by journaling your emotions, how you're feeling while you're in the trade. If you're feeling excitement while you're in profit, are you feeling fear when you're in drawdown, right? How are you feeling in those ways? How is that going to directly correlate to your trading and the potential actions that they may trigger? And this is one of my favorite graphs right here, is understanding the mental game. This is from The Mental Game of Trading by Jared Tendler. If you want to check this out, if you want to understand the mental game, you can break this down into three sections. You have your A game, your B game, and C game. Think of this as a grading system, A game being your best, C game being your worst. When we're in our A game, how are we feeling? Are we feeling very relaxed? Are we decisive, patient, confident? We're trusting our gut. B game, we're overthinking, we're giving some attention on the market, right or wrong. We're losing a little bit of focus, but we're still there. Sometimes we're missing some obvious trades. We're looking at P&L, right? Reacting slower. And our C games are worst game, where we're distracted, we're risk averse, we're hesitating on our entries that we're normally taking. We're forcing trades that we know we shouldn't be taking that are outside of our system. We have no patience. We talk ourselves down. We have self-doubt. We're doing a bunch of things that we know we shouldn't be doing. So if you can break this down and study this and understand what is our mental during our trading, it's going to help us a lot to understand if we're clearly focused and on our A game, or if we're on our C game and we might be a little bit distracted. And this is something we can identify on a day-to-day basis or on a week-to-week basis with different market conditions and how we're personally trading. And understanding, as I mentioned, the mental game is very important. So you can check this out. You can screenshot this, or you can search this up online as well. Another thing to mention is that trading is all probabilities. The only thing certain in trading is uncertainty, right? Trading is based off of numbers, probabilities, and what you have to understand is that every trade, there is not a certain outcome. And with that being said, being right is expensive. As I mentioned, the only thing certain in trading is uncertainty. A lot of people are way more interested in being right than actually making money. They'd rather feed their egos and say, oh, I was right on the trade. But ultimately, you can be right and lose money, or you can be wrong and you can make money. So being right or wrong doesn't mean anything. All that matters at the end of the day is if you end up having proper money management and if you can make money. Because a lot of people, they have too big of an ego, especially when it comes to trading. They want to be right all the time, which is normal. But understand that you're never going to be right all the time when you're trading. Losing is a very key part in trading, and being a good loser is even more important. And finally, what I have here is mental resets, right? Taking breaks / taking a step back. If you're not feeling your best when you're trading, right, don't take a trade, because everything that's reflecting outside of the market is going to directly affect you inside of the markets and the decisions that you make. If you're not sleeping well, if you have external decisions, like let's say you're stressing through your job or something else that's going on that's hindering your mental ability, that's going to directly correlate into your trading, where you might not be as mentally sharp, you might be emotional. It might make you over trade or over leverage coming to market open, and that's exactly what you don't want to do. Or maybe you're in drawdown and you're feeling a little bit emotional. You can always take a step back and take breaks. Most people think that if you're not at the screens 24/7, then you're not making progress. Sometimes taking a step back is one of the best things that you can do, because you can take a step back, reevaluate, look at it from a bigger picture, and majority of times taking that step back will allow you to take 2 to 3 steps forward. So with that being said, these are the best ways to understand your emotions and control your emotions. Now let's go on to the fourth lesson. Number 4, what we have is lack of patience. Patience is one of the most important aspects of trading and waiting for your high quality setups. Because as we know, right, patience pays in trading, and understanding that quality is always better than quantity, and taking less trades usually results in more profits. So what we have to understand is that if there are no setups, there's no trades, right? Not trading is still a form of trading. Majority of the time, you're actually being patient and waiting for your trades to set up. Right? I consider this the 80-20% rule. So 80% of the time you're being patient, waiting for those setups, and only 20% of the time you're actually executing on the charts and taking trades. It takes a long time for most people to realize this, is because they have core beliefs of thinking that the more trades they take, the more money that they're going to make. Especially when I first started trading, I was at the screen 24/7. I was taking 10 up to 50 trades per day, looking for anything in the markets, because I wanted to look for any sort of opportunity to try and make money. But as you'll know, the less is more, and the less trades you actually take, the more money you make. And one of the most common problems is over trading, especially if you're not patient and you don't wait for setups. This is one of the most common problems that I had to face when I first started trading. Was I kept my losers small, but it would be a death by 1,000 cuts, because I would look to enter, re-enter, and my chart would look something similar like this, right? Basically what I would do is I would kind of flip bias on every candle, and I didn't really let the trade breathe, or I didn't let it get to my invalidation point. So if your chart looks something similar to this, where you have so many entries and exits, right? This is a classic sign of over trading, not letting the trade breathe and let it play out and you're not accepting risk. And accepting risk is very important, right? Putting on risk is something different than accepting risk, because in trading, one thing that you can actually do is you can manage your position. So if it hasn't hit your stop loss, technically you can move your stop loss or you can move your profit target. But a lot of the times, what you want to do is stick to a strategy and system. Don't trade if you don't have that strategy and system, and let the trade breathe. Let it play out. As I mentioned earlier, trading is all about probabilities, and letting the trade play out is going to help you in the long run. And a quote that I always live by is plan your trade and trade your plan. Don't micromanage your positions, right? Let your trades play out. Too many people, they're so fixated on the micro time frames, the 1 minute, right? If you have a higher time frame thesis, let your trade play out. Stop staring at every single 1 minute candle. Stick to that 15-minute time frame, the 1 hour chart, and let your plays out for those higher time frame setups, because at the end of the day, those best trades that you hit are based off of the higher time frames. You're never going to hit a home run or have a big trade based off of the 1 minute time frame. And this also plays into a fact is understanding your A plus setup. So this is very important. This is some of the checklists that I have back in 2022. This was based off of my A plus trade checklist in the pre-market. What I was looking for was specific criteria, especially on Tesla, for a potential A plus setup in play. You can read exactly what my A plus setup checklist is. If you do want a video on my updated playbook, let me know in the comments below. But basically, I had a lot of criteria. I still have a very similar criteria to what I have to this day. But basically, what I have here is that 84% of the time, there's a higher time frame move, either breakout or support bounce or resistance rejection. I usually hold most of my trades for 18 minutes on my A plus setups. Ideal hold time is 56 minutes or an hour or end of day. Right, 75% of the time, they occur around 10 o'clock. So I have specific criteria that I look for when understanding my A plus setup. And I basically got it down to a science where if I had the specific criteria, I knew there was a potential A plus setup in play, so I would size accordingly. But basically the checklist is if there's higher time frame setup, we have extreme relative strength, and we also have news as well. If you have news, there's a potential higher time frame A plus setup forming. So this is a very brief summary of what my A plus setup checklist looks like. As I mentioned, if you do want another video on it, let me know in the comments below and I'll make it. And what I wanted to mention is that quality always beats quantity. A good rule of thumb that I always go by is 1 to 3 trades per day. You want to really focus on those higher time frame quality setups. If you take over 3 trades, maybe you take 5 trades to 10 trades, you're basically just throwing something at the market and hoping it works, right? You want to focus to those high quality setups, understand, right, what makes your A plus setup, and then trade based according to that. Because at the end of the day, primarily we only want to be trading quality, and we really only want to be sticking to A plus setups only. So with that being said, now let's go on to lesson number 5. Lesson 5 is overcoming mental barriers when you're trading, because as you know, psychology plays a huge part in trading. Some people say it's 80-20, some people say it's more. But let's talk about some mental barriers and how you can overcome it. Number 1 is loss aversion. So stop labeling your trades by just wins and losses. Most people, they strictly just look at their wins and losses in their P&L, and that determines if they're a good trader or not. Right? What you have to understand is that you could be losing, but you can be taking really good setups. Maybe it's the market condition. Maybe there's certain criteria on why your trade's not working. And you could be winning just based purely off luck. But that doesn't mean you're a good trader and you're going to make money consistently over the long term. So understanding that if you're just strictly looking at your P&L, that's not going to tell the full picture. Of course, P&L over years is a great indication of how good of a trader you are. If you're looking at it in a very small sample size, maybe a couple weeks or a month, that's not big enough to understand if you're going to become profitable over the long term. And the loss aversion also mentions that the pain of losing is twice as powerful as the pleasure of gaining. So if you've ever taken a loss, usually those losses sting a lot more than actually gaining. Why is that the case? Because as humans, we always want to be winning. So when we're winning, we expect it. Sometimes if we have egos in trading, right, we want to win all the time. But when we lose, it's very, very powerful, and we take those losses to heart, right? And that comes with loss aversion, where we may ultimately think that we're losers. We have self-doubt. We have less confidence because we're losing, and we doubt ourselves and question why we're not successful. And understanding that and changing your mindset from strictly just P&L and profit and loss to if we're taking good trades based off our system and our criteria that you have is going to be that important mindset shift. And this brings me to my second point, which is trading isn't about being right or wrong. This kind of ties into the points that I made earlier, but it's about making money and having a positive expectancy in the long run. You can be right on a trade and lose money, or you can be wrong on a trade and make money. What we also have when we're talking about mental barriers is self-doubt. So self-doubt is something that I feel like a lot of traders battle, especially when they first start trading, right? Doubt can come from many sort of factors, right? It can come from lack of confidence. Why are you lacking confidence when you're trading. It makes sense because you don't have experience, right? Experience plays a huge factor into confidence. If you're a brand new beginner, it makes sense why you don't have confidence because you've never seen results, if you never had a reason to become confident. And that is important when it comes to trading and being successful at something. It's different from being confident to having delusion, right? So that's something to mention. Also, other things as well is that if doubt is rooted from general low self-esteem, right, that's something completely different. So if it strictly comes from experience, that makes sense. What you want to do is back test, you want to trade more, you want to gain experience in the actual real markets. If that is not the case and you generally just have low self-esteem, right, you don't believe in yourself, maybe you have some other deep-rooted issues, that's completely different from trading, and you're going to have to fix that internally because, as I mentioned, right, whatever you feel internally and what's going on in your life is going to directly affect your trading ability. So understanding, right, where's the self-doubt coming from is going to play an important fact when it does come to trading. So now let's go on to lesson number 6. Lesson number 6 in this case is information overload, right? There's so much information out there when it comes to trading, one of the most common issues. And what's great about social media is that there's so much information out there, but that also is a con as well, where there's too much information, and especially as a beginner, right? What should you choose and where should you learn from? So the more information does not equal better trader. There's so many strategies out there. There's so many systems. The more that you learn is not going to equate to being a better trader. You don't need to become a genius in order to become a profitable trader. You can have the most basic and robust system, but if you stick to the system, you're going to make money in the long term. I know plenty of traders that are just good at looking at the charts. Maybe they trade ICT, SMC. They overcomplicate their trading strategies. And what are they going to do? Right? They have so many strategies, systems, right? Setups that they're looking for that they overcomplicate and they overanalyze themselves. And then what are they going to do? They're not able to execute. So execution is a lot different than analyzing the chart. And too many people understand analysis, but they don't know how to execute when it comes down to being able to execute when they're supposed to. More information does not equal better the trader. What you also have to understand is that mental capital and protecting your mental capital is so important. So when you're trading, right, think with logic and use common sense. A lot of times, right, if you just use common sense, things will just make sense. But most of the times nowadays, right, common sense isn't so common. So, right, protecting your mental capital, using one strategy, stick to it, stick to your rules, right? Overall, the overview of trading is fairly simple. If you have a proven system and edge, stick to it and don't deviate away from your system. If you deviate, you don't follow risk management, you don't follow your edge, you're going to lose money. So if you think like that and think with logic, it's going to make it a lot easier to trade. And especially, as I mentioned, protecting that mental capital, because that's the most important. If you're out here learning different strategies, if you're out here staring at the screens all day, looking at other things, or maybe overstimulated on social media, as I mentioned, that's going to directly correlate into your trading, and that's going to affect it. And then finally, right, efforts does not equal profits, right? When you're talking about effort when it comes to trading, you can sit at the screen for 5 minutes and make thousands of dollars. You can sit at the screen for hours and maybe lose money or not make money whatsoever. So effort is not a direct correlation to profits. As I mentioned, a lot of people stare at the screens all day and expect to make profits, but it doesn't work like a traditional 9 to 5. Trading is a skill that's not paid for your time, right? The longer you stare at the screen, actually, the less profits you'll make. A lot of times, if you stare at the screen all day, you'll have less mental capital, you'll take more bad trades, and you'll end up losing money. Whereas if you only focus on 1 to 3 quality setups a day, you only stare at the screens for 1 to 2 hours during market open where there's most volatility, you'll end up making the most profit. So there's not a direct correlation between effort and profit. Effort will come from back testing, doing the work that needs to be done outside of market hours. But when it actually comes down to execution, that does not play into account. So that being said, let's go on to the last lesson I have, which is lesson number 7. Finally, what I have is that success is not linear when it comes to trading, and nothing in life is going to go up in a straight line. Most people think that success looks like this, is that it's continuous, never ending, and you're just going up straight without any sort of pullbacks. But in reality, success looks like this, right? We have plateaus, right? We have dips, and we have nice pushes towards the upside, right? It's the exact same thing as an actual chart. And this is very healthy. If it went up in a straight line, of course, we'd love this, but that's never the reality. It's the same thing as a healthy chart. As you can see here, it's the same thing as a chart where you have nice pushes higher, right? Pullbacks, pushes higher, pullbacks, pushes higher, pullbacks, and we have continuation. This is a very healthy looking chart. Understanding that success isn't going to be linear is the exact same thing when it comes to trading. When you're trading, expect periods where you're going to have drawdowns or when you're losing, but ultimately those pullbacks are set up for that next leg higher. As I mentioned, right, you always want to be looking at it from the perspective of 1 step back, right, 2 steps forward. And that's exactly how you should look at trading as well. And then focus on the long-term vision, right? Most people are so fixated on short-term profits and they're thinking about how much they can make today or how much they can can make tomorrow. But what you have to understand is that trading is a long-term game and you need to be thinking in terms of years and not months. This is one of the best advice that I've received from my mentors is that, right, if you're so fixated on making money right now, it's not going to work out. Focusing on the process in anything, it doesn't have to be trading. Anything in life, when you focus on the process, the outcome will follow. And in trading, focus on the process, the profits will come. And treating trading like a business and actually taking this seriously is also another thing. Most people I see don't even journal. They don't have a system. They don't have an edge. All they're doing is basically gambling, right? Trading at the end of the day is a form of gambling, but what you want to do is have the odds in your favor. If you're not treating trading like a business, or you're not treating trading like the casino, like you're the house, where you're going to end up losing money in the long term. What we want to do is make money in the long term. We're not focused on those short-term gains because ultimately how fast you make the money, a lot of times people lose it even quicker. So we want to make money slow, compound, and have consistency over the long term. So with that being said, those are my top 7 lessons that I've learned throughout my past 5 years of trading. I hope you guys did enjoy that. If you did, I appreciate if you guys drop me a like. If you guys haven't joined the waitlist for the event coming up at the end of the month, you guys can do so in the description below. With that being said, I'll see you guys next week for a brand new video. Peace.